Welcome in this video, how Zbcn coin will make a move from here. We will analyze it. Don't forget to subscribe, like, and please watch to the end to understand. A descending curve formed on an asset chart usually represents a curved or sloping line that shows market prices moving downward over time. This descending curve is an important tool in technical analysis for both trend tracking and identifying potential reversal points. Unlike classic linear trend lines, the curve provides a smoother transition and shows that the price is moving downward with decreasing momentum. In other words, the decline is not linear, but continues at a gradually slowing pace. Such descending curves usually form during periods when the market is exhausted, sellers are losing momentum, but buyers have not yet fully stepped in. That's why they are among the structures that need to be carefully monitored. If the price breaks this descending curve and then returns to retest it, this indicates a very critical scenario in technical analysis. The price breaking the descending curve is a very important signal in technical analysis. This breakout shows that sellers' pressure on the price has weakened and buyers have started to take control. Descending curves generally act as resistance. When the price approaches this curve, selling pressure usually increases and the price pulls back. However, in this case, a different situation has occurred, and the price has broken this curve to the upside. This breakout shows that there has been a major shift in market perception. Investors are no longer afraid of falling back below the curve and have started to believe that an upward move could begin. Along with the price breaking this line, there is also a significant shift in the psychology of market participants. The perception of the downtrend continues is replaced with the thought that an uptrend may begin. However, in technical analysis, a breakout alone is not enough. For stronger confirmation, it is expected that the price will return to the curve it broke and make a retest. This retest process is extremely important both technically and psychologically, because during this pullback, investors are watching closely. If the price returns to the curve it broke and bounces upward from there, this confirms that the breakout is not false but genuine. A retest also means that what was once resistance has now become support. This transformation is one of the strongest signals in technical analysis, because now buyers are entering at a level where selling pressure was previously intense. This shows that there has been a major change in market structure. After the price breaks the descending curve and retests it, investor psychology becomes clearer. During the initial breakout, some investors may hesitate. Many market participants wonder, could this be a false breakout? However, if the price bounces upward from the curve during the retest, these doubts disappear, because in this case, everyone becomes convinced that the level has truly been broken and that the price has entered a new trend. This brings new buyers into the market. Fresh buying increases volume, and higher volume pushes the price further up. Thus, the retest both builds confidence and contributes to the price gaining new upward momentum. Descending curves often form after long downtrends. Therefore, breaking these curves represents not only a technical shift, but also an emotional one. During periods when the price has been under pressure for a long time, investors usually become pessimistic. The fear that the price will fall further is widespread. However, once the descending curve is broken, this pessimism begins to fade. When the price breaks upward, hope reemerges. During the retest, this hope turns into confidence, because the price bouncing upward from the retest shows that the market has now embraced the uptrend. From that point on, buying appetite increases and the likelihood of higher prices becomes stronger. Technically, if the price moves upward after retesting the descending curve, this usually signals the beginning of a trend reversal. In other words, the price may have entered not just a short-term reaction, but a longer-term upward process. Curves, especially when used together with moving averages or momentum-based lines, are very powerful trend-defining tools. The price moving above this curve shows that momentum has shifted upward, market participants are taking long positions, and selling pressure has weakened. This makes it possible for the price to reach higher levels. The retest process also provides investors with a very clear buying opportunity. This stage is where risk is lower but potential is higher. If the price has broken the descending curve and is returning to test it, purchases made at this point often turn out profitable, because being at the beginning of the trend and having the breakout built on a solid technical foundation gives the investor a major advantage. Professional traders carefully follow such breakout and retest structures and usually build their strategies around them. That's why these technical formations provide investors with strategic direction. Breaking a descending curve followed by a retest is also referred to as a trend change signal in chart analysis. It is one of the solidest confirmations of trend reversals. Because it's not enough for the price to simply move upward, the move needs to be built on solid ground. The retest is where this foundation is established. The price first returns to the curve it broke and then rises from there as support, proving that the trend has fully changed. This is very important not only in technical analysis, but also in portfolio management. Because when this shift occurs, investors leave behind strategies tied to the downtrend and move towards bullish strategies. For many investors, a descending curve is not just a line, but also an emotional boundary. While the price is below the curve, fear, uncertainty, and losses dominate. But once the price rises above the curve and completes a successful retest, this emotional weight is lifted. Investors leave the shadow of the past behind and begin to look towards the future more positively. This marks the beginning of a new cycle in the market. Because markets are not just numbers. Emotions, expectations, and psychology always drive prices. At this point, the breakout of a descending curve combined with a retest becomes one of the strongest elements in technical analysis. In conclusion, breaking a descending curve followed by a retest is one of the most reliable indicators of a trend reversal in technical analysis. This formation opens a new page not only on the chart, but also in the minds and emotions of investors. The price surpassing this critical technical level and then testing it shows that the balance of power in the market has shifted in favor of buyers. This makes it likely for the price to move higher. When investors analyze such technical structures correctly and make strategic decisions, they can build healthier positions in the market. If a descending curve has been broken and the retest is successful, it means the path for an uptrend is now open. But we can't rely on the curve alone for analysis. Let's also take a look at other metrics. Stay tuned.
The ATR, or Average True Range Indicator, is one of the most commonly used technical analysis tools for measuring volatility in the market. When analyzing price movements, looking only at whether the direction is up or down is often not enough, because speed and momentum are also important. This is exactly where ATR comes into play, clearly showing how strongly the price is moving and at what level the fluctuations are. When ATR starts to rise, it means that market volatility is increasing, indicating that price movements are taking place within wider ranges. An increase in volatility means excitement in market psychology, more activity, and more trading opportunities. Especially in uptrends, a rising ATR indicates that the price is advancing upward more quickly and strongly, because when volatility increases, buyers' appetite rises as well, pushing the price up at a much faster pace. The most fundamental feature of the ATR indicator is that it takes into account the difference between the highest and lowest levels of a price within a day, week, or a certain time frame. These differences show how active the price is. If these differences are small, meaning the price is moving within a narrow range, the ATR comes out low, showing that the market is calm. However, if the price moves within wide ranges, such as a sharp rise one day and a sharp pullback the next, the ATR rises. This rise gives the investor the message that the market is now more active, meaning the price may rise or fall very quickly. In our scenario, it is particularly important that the price is trending upward while ATR is also rising, because this shows that the uptrend is stronger. When volatility combines with an uptrend, the price gains momentum. Volatility is like the heartbeat of the markets. Periods of low volatility are like a slow and steady heartbeat. The market is stagnant and dull, and investor interest is limited. But when volatility increases, meaning ATR rises, the market becomes excited, the heartbeat accelerates, trading volume grows, and prices move more strongly. Investors usually show more interest during high volatility periods because profit opportunities increase. Especially if there is upward momentum and the ATR line is trending higher, this indicates that the price may make quick upward moves. In other words, ATR not only shows how volatile the price is, but also indirectly confirms the strength of the trend. If a price chart shows that the price is rising while ATR is also rising, this is interpreted as a sign of a strong bull market.
The W formation is one of the most well-known reversal patterns in technical analysis, and is also referred to as the double bottom formation. It gets its name because, when drawn on a chart, it resembles the letter W. The most fundamental feature of this formation is that the price forms two bottoms. When the first bottom occurs, the price drops sharply and then makes an upward reaction. After this reaction, the price declines again, but this time it tests the previous bottom level either at the same point or slightly lower. The second bottom is a highly critical level for the market. At this stage, sellers are observed to be losing strength, while buyers become more eager. If the price makes an upward move after this, the W formation is complete. The rally that begins after the second bottom is the strongest signal of the pattern, because the market has formed a base and is showing that it is ready to start a new upward trend. The W formation is a clear reflection of investor psychology. During the first wave of decline, panic dominates, the price drops sharply, and many investors suffer losses. Sales made in this panic push the price to the bottom. However, the initial recovery after the bottom gives hope to investors. With this hope, the price rises somewhat, but since the trend has not yet changed, this rise is short-lived. When the price pulls back again, the market is retested. What is important at this point is that the selling pressure during the second bottom is no longer as strong. Some investors, when the second bottom forms, think, "I won't sell any further," while others think, "This is a buying opportunity," and start buying. Thus, the price stabilizes at the second bottom and gathers strength for an upward move. The second bottom is the most critical stage of the formation, because this is where it is determined whether the trend will reverse. If the price does not fall much below the level of the previous bottom, it shows that buyers are gaining strength and sellers are beginning to weaken. Volume activity also becomes important at this stage. Generally, volume is lower during the second bottom compared to the first. This signals that sellers are no longer as strong. Then, as the price begins to bounce upward, volume increases, confirming that buyers have stepped in. From this point onward, the second leg of the W formation is complete, and the price can climb quickly. The W formation is generally seen at the end of long-term downtrends. After moving downward for a long period, the price eventually forms a base and gives a reversal signal. This reversal signal is very important for investors because catching trend changes provides major profit opportunities. In the W formation, the rally after the second bottom is essentially the first step of a new uptrend. Therefore, investors who identify this pattern early gain an advantage. In technical analysis, the W formation is often considered a reliable reversal signal, and many professional analysts carefully track it. The rally after the second bottom is strong not only technically, but also psychologically, because investors who endured until the second bottom begin to think the worst is over. This belief leads them to buy again. At the same time, investors who had been on the sidelines gain the confidence to enter the market after the second bottom. This chain reaction causes the price to move upward quickly. Especially when breakouts and resistance levels are surpassed after the second bottom, it confirms that the formation is complete. In the W formation, there is usually a resistance level at the midpoint. After the first bottom, the price rises to a certain level, then goes down to the second bottom. When it starts to rise again after the second bottom, that midpoint resistance becomes very important. If the price breaks this level, the W formation is fully confirmed. In other words, an upward move from the second bottom alone is not enough. The midpoint line must also be broken. This breakout is usually sharp because investors watching that level see that the formation is complete and buy collectively. This drives the price up quickly. The target of the formation is usually the distance between the bottom and the midpoint. When this distance is projected upward after the breakout, the target price can be estimated. Thus, the W formation not only provides a reversal signal, but also helps determine target prices. For this reason, it is valuable for both short-term and long-term investors. Especially a strong rally after the second bottom can push the price to the projected targets in a short time. The W formation also proves that the balance of power in the market has shifted in favor of buyers. Sellers are strong at the first bottom, but cannot show the same strength at the second bottom. This shows that the balance is changing. In other words, the formation visually represents the exhaustion of sellers and the readiness of buyers to push prices upward. That is why double bottoms are always closely watched. Many successful trend reversals have been identified early thanks to this formation. The rally after the second bottom is usually sharp because many new buyers enter the market at this point. In addition, technical analysts and algorithms that recognize the formation also support the move. Therefore, the price can show significant gains in a short period. Especially when the perception that a double bottom has formed takes hold in market psychology, the price accelerates. This boosts investor confidence and can lead to the start of a new bull trend. Historically, W formations have been signs of major trend reversals. Many assets, after long-term downtrends, have formed double bottom patterns and then entered strong bull markets. This increases the reliability of the formation. Of course, it does not always produce definite results, and sometimes false rallies occur after the second bottom. But overall, statistics show that this formation has a high success rate. In conclusion, when the price forms a W pattern, creating a second bottom and then making an upward rally, it is considered a strong reversal signal in technical analysis. This structure shows both technically and psychologically that the trend has turned upward. The rally after the second bottom is often the beginning of a new uptrend and drives the price higher. For investors, such formations present major opportunities because positions entered at bottom levels carry high profit potential. Therefore, the move after the second bottom should be closely monitored, and the moment the formation is completed should not be overlooked.
Yes, friends. I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments, analyze the risks correctly, and always take strategic steps. I will be with you with different analyses, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.